Good afternoon, everyone. Thank you for joining our number one webinar here. We got a lot of requests coming out of our clientele with regards to doing a bit of a lithium webinar. I'm just going to give a couple more of our attendees just one more minute before I start. But thank you, everyone, for joining. If you have any questions, as I've mentioned there, please don't hesitate to ask to put that there in your chat function on the top right-hand side of your screen. Okay, I think that's plenty of time there. So thank you again, everyone, for joining today's webinar. Today, we are here from Stock Specialist. My name is Marcos Gomez, as always, the portfolio manager here at Stock Specialist. Today, as I mentioned previously, we had a lot of feedback with regards to what's occurring, obviously not just in the market, but with regards specifically on the lithium market as well. So today we're going to focus quite a bit on that, and hopefully we're going to give you a few insights that you haven't seen before. As always, just a quick detail. Just give me 1 second here. Yep, so just as always, a bit of housekeeping. If you require any personal advice, please, of course, go to your personal financial broker or financial planner. The content in today's webinar is, of course, only general advice only, and previous performance is not indicative of future performance. However, a lot of the performance that we've had is pretty great. So we're primarily focusing on, with regards to our agenda here, we've got our market movers. We're talking about what we have to do when a recession hits. And of course, our three top stock picks with regards to the lithium market. We've also got one sort of hidden gem in there as well that a lot of clients probably wouldn't really think as a lithium stock, but is actually quite performing quite well. And we're also going to do a little bit of a discussion as to how our portfolios specifically have been going and where we're focusing our channels going forward. So we mentioned last week, how we expected the ASX 200 to focus going into 2023, and we mentioned specifically on the China reopening. And when we mentioned that, we were quite positive on that affirmation. And since then, the ASX 200 has actually rebounded almost 5% since that early January 2023. Not suggesting that that is going to sustain its current course, but it is a positive sentiment going forward into how we're actually focusing and where we're investing and how we're rebalancing our portfolios internally, and how you can possibly take a look a bit of that insight there as well. So as we mentioned specifically, the ASX 200 continues to outperform the vast majority of markets around the world. Not just in the Asian markets, the Hang Seng and the Shang Seng Index. Of course, the Nikkei as well has done quite well, coming off the back of the Japanese inflation rate as well. But the ASX 200, you can see just off the monthly chart there, has actually increased of about 5.4%, and basically not too much else really going on. The US still really faltering. The S&P 500 has come up a little bit. That has been primarily bolstered as well by a lot of the tech sectors that have come through there. But we'll talk a little bit later about that going forward. But primarily, we want to still focus on 2023. Despite these initial few weeks of, I guess, post-Christmas epiphany, everything is seemingly going well. But however, interest rates are still going to be increasing. Inflation coming off the back of actually Wednesday's CPI inflation that came out of Australia domestically. The inflation rate was vastly higher than was expected. The domestic CPI was about 7.8% domestically increasing, not out of what a lot of analysts were forecasting, primarily out of the domestic housing market. It was actually out of the consumer staples sector primarily, and of course energy costs as well. So our base case scenario still remains the same. It's a point of inflection. And this is where a lot of analysts and a lot of economists have been concerning themselves. Where is actually the pivot point? Where are a lot of these global economies going to change their outlook when it comes to not just inflation, not just interest rates, but overall economic growth against a very complex geopolitical backdrop? When I say geopolitical backdrop, I mean an innumerable amount of things, primarily, of course, the energy crisis coming out of Western Europe, the geopolitical tensions coming out of Eastern Europe, the energy crisis coming from Australia, and consumer staples as well across the globe. And of course, I believe it was on Tuesday this week that the US actually hit their max, about 3.5 trillion debt level. It's a maximum debt level that the House of Representatives has not actually provided legality, and they don't actually have the capacity to actually increase that debt level forward. So a lot of real concerns. So this is coming. I thought this was quite an interesting quote coming out of the World Bank. As central banks across the world simultaneously hike interest rates in response to inflation, the world may be edging towards a global recession in 2023. That's coming from the World Bank. That's not coming from me. I'm not necessarily sure whether global recession is the correct word for it. Excuse me. I do believe there will possibly be quite a bit of stagflation. Stagflation, of course, is when the unemployment rate is low, inflation is high, and basically wage rates are staying quite the same. And essentially that just means that the development and the cost of living, of course, is passed on to consumers, and that's really not the best result that we want. So the probability of the recession, we've actually done quite a bit of analytics on this, not just ourselves, but also Moody's, one of the top rating agencies in the world, rates the probability of an Australian recession in the next 12 months as a 0 to 32% chance. Doesn't really mean a lot. Doesn't really mean too much, but you can see how that actually complies as to what we were saying quite a few weeks ago as to how the ASX and the Australian economy in general is quite resilient to an inflationary and a recessionary environment. You can see there that Australia is in the green, which is great, always good to see. The primary concerns, of course, are Russia. You can see there in the dark brown, already in recession, vast recession. And of course, Western Europe, you've seen there the economies of Germany and France. France and in Italy as well, 66 to 100%. They're already primary in there, and you can see, even though it's very small on the map, but it is quite a large economy by all rights and concerns. You can see there the UK is already in a recession with upwards of 10.5, 11% inflation rate. So we can see there that Westpac is expecting a more moderate headline inflation. That was what they were expecting prior to the most recent results coming out on Wednesday. 7.4% prediction, and the inflation rate was hitting 7.8. So they're expecting that terminal rate to hit about 3.85. We're still expecting that terminal rate to sort of hit approximately that 4% inflation. And that's a 4% cash rate, by the way. So that 4% cash rate is not necessarily just what you're paying on your of course, your mortgage, what you're paying on your personal loans, all those sorts of things. The actual cash rate, the terminal rate that is paid between banks, of course, the higher rate is passed on to consumers. So that's also an ongoing concern. But the looking, of course, on the positives, which of course is something that we always like to look at. It's the transition from recession to growth, and we've mentioned this a couple of times. You can see there on the top left hand side of the screen, in terms of the forecast for the ASX 200 for end of year pricing for the ASX 200 for 2023. Credit Suisse is the only one that has recommended or forecasted an ASX 200 pricing of 6,700. Well, I could probably do a whole webinar as to why that's probably not feasible, but that there are quite a lot of reasons as to why that. But our recommendation and our forecast is sitting quite similarly to where UBS and JP Morgan are sitting, about that 7,300, 7,400 mark. And primary reason, of course, for that is we do expect a 4% earnings contraction in the United States and a 10% decline in Europe and 2% growth in Asia. And the reason that we make that forecast, of course, just on a top level, is to do with the terms of trade and who we actually do trading with our exportations and our imports are primarily affected by Asia and primarily affected by the US. So the declines in Europe, despite it being an actually emerging market currently, specifically with regards to energy requirements and energy demand, the terms of trade and our overall economy demand will still be quite focused on the Asian and the North American markets. So on a positive note, that's why I bolded it there. We still project Australian earnings, and when I say Australian earnings, I mean Australian stocks and Australian companies, growth of about 4%. So it's slightly longer than long-term growth rate. And when I say long-term growth rate, normally that means about 12 to 24 months. Right now, we've sort of terminalized that to about a 2 to 4 year expansion, and we'll go from there. So the risks to navigate, I think this is something that a lot of people have been focusing on quite fervently. And you can see here that the economists, I should probably get that right, as I am one. But economists have actually cut their China growth forecasts at least, and they say at least, that means Q3 2023. That actually means it's probably going to go to about 2024, 2025. They've actually cut it quite significantly. So China, of course, is still Australia's biggest exporting market. They take about a third of our country's exports, which is huge. It's massive. It's not necessarily just energy. It's not necessarily just coal, LNG, all sorts of things. Bananas, camels, whatever is actually required through them. But the one of its three key outlook uncertainties from the actual Reserve Bank of Australia is the China growth and the Chinese actual rapidity of growth going through this recessionary environment. Point number two would be, of course, Australia's interest rates do definitely have a further way to go. A lot of you're seeing, I'm sure you've seen a lot of sophisticated investors such as yourselves have been reading articles from the AFR, from ANZ, Westpac, all the big four. They tend to downplay a lot what's going on. But the rhetoric, despite the rhetoric, the terminal growth rate and the terminal interest rate will still be sort of peaking about that 3.85% to 4%. And of course, point number three, economic growth will slow. We've already seen this out of the US GDP and the US retail sales that we went through last week. The US retail sales growth actually quite reduced despite things like such as Black Friday, Cyber Monday, all these, of course, the Christmas holidays. Retail spending has dramatically reduced. And of course, that's due to disposable income, of course, being reduced. So we are looking forward to focusing on how we can actually maintain our members' capital and, of course, grow it. And we've had quite a lot of success doing that this last year during 2022, and we want to focus on how we can achieve that going forward. So as I said, I'm not going to focus too much on this, but as I said, we do have quite quite a sophisticated database, and we don't have a lot of spaces for this exclusive deal. But for our exclusive webinar viewers, I'm sure a couple of you have heard this before, but for those who haven't, we only offer 2 packages, and our gold package basically provides you with our daily financial report, and of course provides you access to our income growth and our ETF portfolio. And of course you have your account manager on speed dial during work hours, of course. And our diamond package is the best value and the best seller, of course, that we've had. That provides you in our income portfolio, which is done about 15%. Well, actually, I'll provide those details later. I'll actually provide a couple of slides on that. But that provides you with our income portfolio, our growth portfolio, our mining portfolio, which is actually the stellar portfolio, which we've been recommending for quite some time, especially during our webinars. We've got our defensive bear portfolio, our technical analysis tools, our software tools, and of course, most importantly, you have the opportunity, either quarterly, half yearly, or on a yearly basis, the ability to have a chat with one of our portfolio managers, including myself or one of my analysts, to actually dissect your portfolio, rebalance it, and notice whether you're either underweight or overweight in a particular sector, see what your actual requirements are, and we can help you out with that. So we never really do it this great, but our best value there is for a 3-year diamond membership, and primarily focused on a 3-year membership. That's what we're focusing on, because the primary rebalance is it's not a 3-month thing. It's a 2-year, 3-year thing. Considering the amount of macroeconomic concerns that we have, and the macroeconomic concerns that a lot of our investors and a lot of clients have around the world, that's something that will generate obviously the best value. So if you have any questions, of course, please pop it in the chat. A lot of our clients, a lot of our customers will be able to help you out there. So best thing, of course, is the 3 of our top stocks to navigate through this challenging time. I think this is primarily what a lot of our clients are looking for, and a lot of our prospective clientele are looking for as well. So number 1, I don't think this comes as any of a surprise. Pilbara Minerals, PLS. If you haven't heard of it, please get heard of it. Pilbara Minerals, it's an Australian lithium and tantalite mining company. Tantalite, of course, is one of the platinum group elements. We've been recommending Pilbara. You can see there just on that little chart, very good chart, about that $2 mark. It's currently trading about that $5.10 mark. That's, well, obviously over 150% return for our clients. And you know what, we're not necessarily done with it, and there are a vast majority of reasons for that. The 3 reasons why we like PLS: the inaugural dividend. Everyone likes dividends, correct? The inaugural dividend is forecast to be paid during the financial year 23. I know that's a little bit of concern for a lot of people as to when that actually is going to be, but I can talk to that forward. But they have a solid expansion pathway to production of 1 million tons per annum, and have, of course, consistent revenue growth year on year. So you can see here, I won't focus too much on this slide. This is basically just production and sales up quarter on quarter. That's, of course, we all knew that, but this is the slide that I really wanted to focus on. Excuse me. So you can see here the P680 expansion. The P680 expansion is primarily focused on creating 680,000 tons of 6% spodumene concentrate per annum, all right, based off the Pilgangoora plant and the Nugajoo plant, which of course Pilbara also owns. The P680 expansion has already been revised. The final investment decision has already been finalized, and the contract has been provided to a company called NRW, which is one of the best mining services companies in the world, And if you know anything about Twiggy, the CEO of Fortescue Fortescue Mining Metals, I apologize. That is the same mining services company that he uses. And Pilbara has secured that mining contract with NRW to focus and capitalize on the high lithium spot market that they have going on. And the second expansion, which will be the P1000, they're close to pre-FID funding, and that's coming into the March quarter 2023. So that's literally just in 2 months. The P1000, as you can see by the naming convention, which basically means 1 million tons per annum. 1 million tons of spodumene concentrate at 6%. Just to give a little bit of clarification, the current spot, not just the actual contract pricing that Pilbara has actually achieved for their spodumene concentrate is at $6,300 per ton. $6,300 per ton, times that by a million. Well, you can do the math. I don't have to do it for you. So the primary thing that I wanted to talk about is with regards to their inaugural dividend. A lot of clients have been asking me as to when the actual dividend will be applied. And with regards to their capital management framework, they've been talking about applying the inaugural dividend to the financial year 23 financial results. Okay, it seems a little bit vague. However, in the last quarterly result that they reported, their cash balance was actually $2.2 billion in cash, based off the previous quarterly, the December quarterly. So myself and a couple of my analysts, and of course UBS and everybody else, we all went and attended the December quarterly webcast and asked a few questions. And we're still not sure. Of course, this is all just based off the webcast, which is actually available on the website as well. But the inaugural dividend is actually in discussions whether to bring that closer to a March dividend or whether to be a September dividend. Okay. However, regardless of whether it will be paid, you can see there on the left-hand side chart, the target dividend payout ratio will be about 20 to 30% of free cash flow based on the financial 23 dividend cash flow sorted. So even just based off that, the forecasts are varied based on either on the lower end, either a 10-cent dividend or a 35-cent yield. Either way, I think it's fantastic. I think a lot of long-term holders of Pilbara have been waiting for this dividend for quite some time, and the forecast dividend yield is approximately about 5.4% overall, and that will be fully franked. All right, that's a fully franked dividend yield as well, and they have the primary reason they've only sort of allocated 20 to 30% of free cash flow is because they've actually prioritized further growth paths. They have a lot of other things going on. They have their P680 expansion, as I mentioned. They have their P1000 expansion, and they also have midstream and downstream projects, particularly with their joint venture with POSCO, which is something that I'm really interested in. POSCO, for all those who are not aware, POSCO is a South Korean lithium hydroxide producer, lithium battery metal hydroxide producer in Korea, who are very well established, fully funded hydroxide plant going into South Korea. That's Pilbara has a joint venture with them. They have an opportunity to have a 30% opportunity to, of course, provide the spodumene concentrate and also take a margin on the hydroxide. So to give you an example as to the margins that are being achieved, so the current spodumene price per ton is approximately that $6,000 per ton. Pilbara's cost per ton is actually quite low, very competitive, about $500, $600 per ton. Fantastic. That's about 80% margin growth. On top of that, providing a low cost high quality spodumene concentrate to a hydroxide plant. The hydroxide plant is currently, well, if you take a look at the current lithium hydroxide price, it is about 75,000 US per ton. Taking about 30% of that margin is huge. Basically, fully funded, all going there. And Calix is another joint venture as well, but that's something that we can talk about at a future time. So you can take a look at this. You know, obviously there's a lot going on, but I really wanted to touch on this quite quickly. You know, the Pilbara price action, since that price action that we recommended it at $2, 157%. I can't really recommend anything better than that. And it doesn't necessarily mean that's the end. I think our current target price, just for our webinar viewers, of course, our current target price for Pilbara is about $6.50, and that comes with a 9-month to 12-month time horizon, primarily based on how they effectuate that dividend payout. But we're really happy with how that's really achieved amazing results for our clients, and yeah, we can't really say enough. So the next one that I wanted to talk about is ALS. This was the hidden gem that I was speaking about. It's not really the more lithium stock. When you think about lithium stocks, not really something that you think about. However, ALS has had, if you can see there on the right hand side, consistent earnings and dividend growth, EBIT margin fantastic. But what ALS focuses on is testing, inspection, and certification. TIC. TIC primarily, it doesn't really sound like much to a lot of general viewers, but TIC is quite focused primarily on the mining industry. So for example, if you're invested in a gold stock, say you're invested in Northern Star, say you're invested in Newcrest, say you're invested in Fortescue Metals, whomever, anyone who sends out, does a drill assay, they do some reverse circulation drilling, and they provide drill assay results, whom do they send it to? They send it to companies, TIC companies like ALS. ALS has really performed quite well, especially you can see there since that 2020 dip after the COVID pandemic. You can see they've performed quite well. They still have about a 3% dividend yield as well. They have verification services out of 370 sites in 65 countries. But the strong financial performance is from 13% organic growth. And it's not necessarily just out of mining services, it's also out of life sciences as well. So all these assay results that they provide to companies like ALS, providing those accuracy of data is something that's very important. I think this was quite impressive. You can see there the NPAT, the net profit after tax, and the interim dividend has actually increased by almost 30%, 29% last year. And this one has been really good for quite a lot of us. And you know, these are the kind of things that I think a lot of our longer term clients have been really focusing on. They're not really focused on making, you know, 100 times their money, you know, 50% here, 50% that. We're not suggesting it's going to do all that, but this is a company that actually acquires through transcendental growth, inelastic growth. And when I say inelastic growth, inelastic demand, it means that the demand for mining companies and the mining services industry has actually increased the revenues for companies such as ALS to actually improve their NPAT and improve their profit margins quite significantly. And you can also see there on the right hand side, their sustainability has been quite good. You know, they're also achieving to the net zero roadmap by the end of financial year 23, which is great as well, which we also wholeheartedly support. So I thought that was a little one to keep on there. And of course, if you want to take a look at their expansion worldwide, you can see how they've completed 8 acquisitions just year to date, 90 million revenue year to date. And of course, they have a vast M&A exposure platform going forward. So the last one, okay. Well, I have to talk about this, don't I? And yeah, as I mentioned, since our recommendation, ALS, unfortunately, the ticker code is called ALQ, very disorienting. But ALS, ticker code ALQ, is actually up over 80% since our recommendation. We currently have a target price there. I will have to check that. I'm not going to say what our target price is there. I haven't set it particularly, but they do have that 3% dividend yield as well. But any questions, of course, feel free to let me know. Give me a call. I'm not here to give you any recommendations that I don't believe in. You can always give me a call on my personal number as well. I believe a lot of our clients have already got that, so I'm not going to go forward with that. But the last one is Orcam. So Orcam's been a little bit of an undervalued one. It's a specialty lithium company. It actually has a global portfolio. A lot of people don't actually know this, but Orcam has I say there on point 2 on the right hand side, could capture. They actually have a 10% market share of the global lithium market, and they're on track to triple their production by 2026, and that is via these things. So you can see here, they have the Mount Catlin hard rock spodumene production in Western Australia, of course. They have a hydroxide plant also in South Korea, I believe, and the primary ones that Orcam generates the vast majority of their revenue are from the Olaroz and Sal de Vida brine from the South American brine operations. So we'll talk a little bit about that and how the lithium carbonate price compares to the hydroxide price and how that goes. But first, we'll talk about timeline. So for those who don't know, Orcam was actually previously well, I guess the children of Orocobre and Galaxy Resources. I'm sure a couple of you were invested in Galaxy Resources back in the day. And Orocobre, of course, during those South American brine companies. So with the merger with Orocobre and Galaxy during 2021, they formed the company called Orcam. All right, so that's Sal de Vida and all these sort of brine recommendations. They've been sort of going on to a lot of, I guess, a lot of naysayers with regards to how they were performing, what their recommendations were, what the actual recovery rates were, and their costs. The costs were the primary things that were going forward. So going next there. You can see there, based on the Mount Catlin, Olaroz, Sal de Vida, and James Bay. Excuse me. You can see James Bay won't be realistically going online until 2025. We're not really focused on James Bay. We're really focused on the primary increase of Olaroz as well. So Olaroz is going stage 2 at about 2025 with very, very competitive costs. And the reason that I bring this up is because if you've kept online with a lot of the lithium market news, you would have seen previously, only about a week ago, Liontown Resources increasing their capital cost requirements previously from their DFS to actually create their mine from about $400 million to about $800 million, almost 100%. Well, yeah, it wasn't great, and their share price has suffered for it. However, a lot of CEOs, particularly one of the biggest lithium miners there, Albemarle. I'm sure you've heard of them. Albemarle CEO actually came out stating that the Western Australia, the Australian cost for production in mining is actually about 50% higher than it is anywhere else in the world. So that is, of course, a lot of concerns. That, of course, comes through with, of course, labor costs, unskilled labor, time shortages, all those sorts of things. But Allcom has actually maintained that and on cost on budget. So again, I'll push that on there. Allcom as well is up about 76% since our recommendation. So overall, I think a lot of clients actually have been asking me about the possibility of Allcom paying a dividend quite soon. I don't think that is the case. I think they have a lot of capital management further ahead, but within the next sort of 12 to 18 months, that may be a possibility, depending on whether they're able to mitigate those costs and keep them down. So definitely one to keep on the watch list. We still have a good buy on Allcom. We have a target price there of $17 for Allcom in this 6 to 9 month term, based on, of course, which we will of course keep a massive eye on, depending on how they manage those capital growth plans, and that's the most important part. So I just wanted to touch on our portfolios for a little bit. And you know, our portfolios have been functioning quite well. I know a lot of people like to say, oh, well, you're only focusing on the good ones. Well, that's not true. So you can see here, even our income portfolio, a lot of them we do have holds on, and a couple of we do have reducers on. Of course, I've taken away what the actual ticker codes are, but you can see that the income portfolio specifically, you can see that we've rebalanced out of the income portfolio as the interest rates, the domestic and international interest rates have risen. We've rebalanced a little bit out of the income portfolio because it's not necessarily as competitive to hold an income portfolio as it was, say, when interest rates were 0%. Despite that, it's actually returned over 5% year to date in a couple of weeks. So we're outperforming the ASX by 3.5%. Not bad. But our primary one, our mining portfolio has actually returned 11.52% year to date. And, you know, those, we've only got those reducers, we've only got one reduce and one sell. And those are not necessarily, those were actually news recommendations. They weren't actually part of our portfolios, but the vast majority, those 12 out of 10s, were part of our mining portfolio. And our mining portfolio last year actually produced about 60% return for our clients. So I just wanted to leave you with a little bit of our base case, just to give you a little bit of headway, something to think about going forward into the rest of the year. So given our base case for 2023, we are still seeing a potential return to growth in the second half of the year. And this is what I'm saying, second half of the year. Despite this, of course, there is an increasing probability of global recession. There is an increasing global probability of recession. And you want to primarily focus on these four assets that I'm going to slightly touch on, but I think the primary focus of the service and what we can provide is how you can actually focus on that. So gold, look, we've I don't I don't really need to focus too much on this. You can see that if anyone who has been following our webinars previously, you can see that when we actually recommended gold as a contrarian play back there in November 2022, basically at the back end of last year, we recommended gold when it was sitting about 1700. People sort of, you know, weren't really convinced. They weren't really convinced, and we said, okay, we'll take a look. And this, we're not suggesting put all your money into gold, not necessarily, not at all. But it just shows the power and the capacity and the ability for investors to make money in a contrarian environment. So gold, of course, is something definitely to take a look at, and that is something we can help you out with. Defensive assets. We recommended IXJ, the Global Healthcare ETF. It's consistently outperformed the index, 38.5% return, minus the ASX 200. So if you're looking for more defensive assets, something that will outperform, but nothing that's too crazy, healthcare is definitely something to take a look at as well. And of course, consumer staples, IXI. IXI is the consumer staples ETF. Look, I'm a little bit concerned just on that later term chart. Consumer staples, unfortunately, particularly on the ASX, is quite saturated. There aren't a vast majority of consumer staple stocks out there. You've got a couple of your pharma stocks. You've got your Woolies, you've got your Coles, you've got your Metcashers. But there are, quite a few different stocks that you need to take advantage of, particularly going forward. All right, and of course, the income yielding ETFs. So the big one for a lot of customers and a lot of clients have been focusing on how to maintain their dividend yield despite interest rates going up. And so the big question is, should I just put it back into a savings account? Not necessarily. Your savings account will probably give you maybe 4% at the current moment. However, there are still great stocks that you can still take advantage of. VHY, if you're not looking to bug around with particular stocks, VHY, the Vanguard Australian Share High Yield ETF, is a great one. It basically has a great pick of the highest yield ETFs on the ASX with a very low management fees. We also don't have any affiliation with this ETF. We just think it's a great one. But we also did have an income webinar a couple of weeks ago where we spoke about the highest yield stocks on the ASX, which we can also help you out with as well. So if you're looking for yield, you can definitely still get it on the ASX. So just to finish up, guys, I've already mentioned this a couple of times, but I really do think that the vast majority of people here will generate quite a lot of value from actually seeing what we actually do. I've tried to establish this only in a sort of an hour webinar, and there's only so much I can say within 1 hour. But hopefully you generated a lot of value from listening to what I've had to say. And if you have any questions, of course, our team is ready and waiting to listen to any questions that you may have. Please feel free to give us a call, if you can send us an email at admin@stockspecialist.com.au, or you can actually give myself a call, Marcos, at 0459 934 889. And any questions there going forward, please feel free. I will also be answering all the webinar questions that have been sent through. Thank you all for your attendance, and I look forward to us answering all your questions and speaking to you later. Thank you so much, everyone.